There is a word people use almost every day when talking about buying a home, yet very few ever stop to question what it actually means or where it came from. It sounds technical, even modern, but its roots go back to a time when lending money carried far more immediate and serious consequences. So why is it called a mortgage, and what does that name reveal about the way borrowing and ownership were once understood? Hidden inside this familiar term is a meaning that feels surprisingly literal and slightly unsettling once you understand it. That is exactly what we are going to explore today, right here, on History of Simple Things. The word mortgage comes from Old French, combining mort meaning dead and gage meaning pledge or security. Together it created the term dead pledge, which described a loan arrangement where property was used as collateral. The word dead did not refer to physical death, but to how the agreement ended in all cases. If the borrower repaid the loan, the pledge ended because it was no longer needed. If the borrower failed, the pledge also ended because ownership transferred to the lender. In both outcomes, the pledge ceased to exist as an active claim. This reflects how early legal systems treated debt as something tightly bound to property rights, where land was not just owned but temporarily committed under enforceable conditions tied to repayment. In medieval England, land was the most valuable and stable form of wealth, making it the natural foundation for lending agreements. Because money circulation was limited, borrowers often needed to use land as security when receiving loans. Lenders, usually wealthy landowners, would provide funds in exchange for legal rights over the property if repayment failed. These arrangements were carefully documented to define each party's obligations. The borrower could continue using the land while repaying the debt, but the lender held a strong legal interest in it. This system made borrowing possible in an economy with limited cash flow, but it also meant that failure to repay could lead to permanent loss of land, often including inherited estates that held both economic and social importance. A central feature of early mortgages was conditional ownership, where property rights were divided between borrower and lender. The borrower retained physical use of the land, but the lender held legal control as security until repayment was completed. This meant ownership was not absolute but depended on financial performance. If the borrower repaid the loan, full ownership remained or returned to them. If they failed, the lender could take possession legally. This arrangement created a system where land functioned both as personal property and financial guarantee. While it allowed access to credit, it also created significant risk for borrowers. Over time, this structure became a foundation for more advanced legal systems that separated ownership from financial security in clearer and more regulated ways. English legal development introduced key protections that reshaped mortgages. One major principle was the equity of redemption, which allowed borrowers to reclaim their property even after missing payments, as long as they repaid within a court-recognized period. This was a major shift from earlier systems where lenders could quickly take ownership after default. It reframed mortgages as temporary financial agreements rather than permanent transfers of land. It also gave borrowers a legal route to recover property, improving fairness in lending. Over time, this principle became central to property law and shaped modern foreclosure rules requiring formal legal processes before repossession. In the modern financial system, mortgages are standardized loans offered by regulated institutions like banks. Instead of informal land agreements, they rely on contracts, interest rates, repayment schedules, and credit scoring. Borrowers commit to long-term payments, often over decades, while the property serves as collateral. Regulations require transparency, clear disclosure of terms, and strict procedures in case of default. Credit systems help determine eligibility and loan conditions. Even with this complexity, the core idea remains unchanged. Property is used as security for borrowed money. This shows how modern housing finance still reflects older legal and economic foundations. The term mortgage has survived because it remains legally precise and historically rooted. Even as financial systems evolved, the idea of a secured pledge stayed the same. Legal language often preserves older terms to maintain consistency across centuries of contracts and regulations. Replacing such terms would create confusion in law and finance, where clarity is essential. As a result, mortgage continues to be used in both formal and everyday contexts, linking modern borrowing to its historical origins. Its endurance shows how legal language changes slowly, keeping original meanings alive even as financial systems become more advanced and global. The word mortgage carries a long and layered history that reflects how societies once understood debt, land, and ownership. What began as a dead pledge in medieval Europe has transformed into a structured financial system that enables millions of people to purchase homes through long-term credit. While modern mortgages are highly regulated and standardized, the underlying idea remains the same. Property is used as security for borrowed money. Every time the word mortgage is used today, it quietly reflects centuries of legal development, reminding us that even the most ordinary financial terms are shaped by deep historical roots. Thank you for watching. If you have suggestions for our next video, feel free to share them in the comments below. We'll be sure to give you an acknowledgement for your contribution. Thank you for joining us on this journey through the history of simple things. Don't forget to like, subscribe, and stay tuned for more stories woven through the smallest details.